Hello and good day. Welcome back to our class. This is teacher Oninti Guzman and our topic for today is working capital policy under business finance. So the outline of our topic for today, we have the working capital, then we have importance of capital policy. Number three is the policy on the current level of assets. And number four is the policy on financing the current assets. And finally, investment and financing plan. If we say working capital, it is strictly refers to current assets. So in financing world or accounting world, so we have working capital is equal to the current assets minus liabilities, such that strictly in this context, we will talk about cash, trading securities or marketable securities, then we have accounts and notes receivable, and finally we have inventories. The question is why working capital policy? So with an adequate working capital, the business is able to perform the following. So maintain good credit standing with financial institutions and other creditors, settle the operating expenses of the business on due dates, regularly replenish the inventory, avoid default risks, and finally, exploit business opportunities. The matching of the current assets and the current liabilities is very essence of having well-defined working capital policy. A clear working capital policy is necessary as the business grows. Without business growth, establishing a working capital policy does not mean or amount to anything in the field of finance. So a business with a favorable working capital level is likely to assure short-term creditors that its liabilities will be settled promptly upon maturity. In addition, a business that has adopted a financing mechanism that is most advantageous to the business will experience fewer problems in funding the level of current assets. The level of current assets refers to the amount that must be maintained in order to achieve the objectives and goals of the business organization. So the basic question that should be properly addressed in the information or formulation of policy on the level of current assets is what is the level of current assets that business should maintain in terms of the total assets in relation to total assets. Letter B, amount of a specific account in relation to total current assets. There are no rigid rules that set the level of current assets of a business. However, the following factors are considered in the process of evaluating the level of current assets to be maintained. So number one is the nature of business. Number two is the types of items produced or sold. 3. Current industry practices. Number 4 is the government policies and programs. Number 5, manufacturing process involved. And finally, credit terms of suppliers and customers. After considering the different factors mentioned, a business may adopt one of these three types of working capital policies. So we may have conservative current asset policy. We may have also aggressive current asset policy and moderate level working current policy. These current asset policies are considered as the investment policy of the business. Investment policy addresses the allocation of resources of the business between current and non-current assets. So if we will move on to the conservative current asset policy. So business that maintains a high level of working capital. So if we will look on the diagram, so if this is our current assets of 4 million, while our non-current asset is 1 million, and the total resources is 5 million. As you can see, much of the assets are actually intended for the current assets. There is only few or very little intended for the non-current assets. So this is how we allocate our total resources under conservative current asset policy. On the other hand, if we will say aggressive current policy, so the business adopts a low working capital policy on some factors influencing its operations. So say for instance, our non-current assets is 4 million, while our current assets is 1 million. So this is directly opposite of the conservative current asset policy. So the total is actually 5 billion for our total resources. Moderate current asset policy, it means that it is an approach adopted by a business when the expected level of current assets is not too high or too low. So if we will look on our diagram, the current asset is 2.5 million, while the non-current asset is also 2.5 million. So the total is equal to 5 million. So take note that there is equal for almost the same level of current assets and non-current assets under the moderate current asset policy. The level of working capital suggests two important concerns for the financial manager. So the first one is the concept of risk. So when a business maintains a high level of current assets, the risk generally minimized if not eliminated. The second one is the return of investment. It means that it is the measure to determine the profitability level of business. So there is trade-off between risk and return of investment. When the risk is high, the return of investment is also high. On the other hand, when the risk is low, the return on investment is likewise low. It is the primordial task of the financial manager to evaluate the situations and the surrounding environment to favor either the risk or the return on investment. In formulating the working capital policy, the business determines the best source of funds to finance receivable and inventories. So we have the following possible resources. So number one is the suppliers through accounts or notes payable. Number two is accrual liabilities. Number three is short-term bank loans. Four is the long-term bank loans. Five is the long-term debt through issuance of bonds. And finally, equity through the issuance of shares of stocks. The following terms are used in succeeding session are operationally defined as follows. So the first one is temporary current asset. It means that normally converted into cash within the normal operating cycle of the business. Number two, the permanent current assets. They are portion of current assets that accumulates and remains through operating cycle. Number three is the spontaneous debt. It refers to short-term debt that arises from the normal course of business operation. We have also non-spontaneous debt. It refers to debt that arises not from the ordinary business activities but from borrowings from bank loans. And finally, total permanent asset means it is the sum of permanent current assets and fixed assets. It is worthy recalling the basic business equation where assets or resources are equal to liabilities and equity. So that is why assets is equal to liabilities or this plus equity. So the assets of business are broadly classified into current assets and fixed assets. So liabilities are likewise classified into current or short-term and non-current or long-term. So the equity of the business represents the residual interest of the owner or owners. So the first of which, okay, policy on financing the current assets is what we call aggressive approach. So we have here the types of approach. We have the total temporary current assets and part or permanent current assets. Then the source of funds, we have here the short-term non-spontaneous debt. On the other hand, part of permanent current assets and total fixed assets are for long-term debt, equity, and spontaneous current liabilities. But if we will move to conservative approach, the types of assets are the following. Part of the temporary current assets. So the source of funds are short-term non-spontaneous debt. On the other hand, part of temporary current assets, total permanent current assets, and fixed assets. So the source of funds are long-term debt, equity, and spontaneous current liabilities. The last one is the maturity matching approach. So the types of assets are all temporary current assets, and it will be sourced from short-term non-spontaneous debt, while the total permanent current assets and total fixed assets are financed by the long-term debt, equity, and spontaneous current liabilities. The relationship of the investment and financial policies in working capital management with the accounting equation is reflected on the figure, such that assets is equal to liabilities plus equity. So the financing policy will enhance your investment policy. So take note that this section evaluates the effect of interest, particularly on the sum of equity based on the type of financing adopted. So using the measure of return on equity, the return on equity is computed as follows. So that is net income applicable to ordinary shares divided by ordinary shares equity. So take note that the of equity applies only to ordinary shareholders because preference shareholders have fixed rate of return on their investments. Let's consider this word problem on investing and financial plan. So the total resources of the Guzman Corporation as of December 31, 2020 is 20 million pesos. Of this amount, 8 million is considered current assets while the remaining balance is 12 million pesos is for fixed assets. The equity of the ordinary shareholders amount to 10 million. The earnings before interest and taxes are expected to be 5 million with 30% applicable tax rate. The Guzman is considering two financing plans to fund the requirements of the assets as follows. So the plan A is conservative. So the 2 million will be sourced from short-term debt at 10% interest and the remaining balance of 8 million will be financed through long-term debt at 15% interest. So the plan B is aggressive. So 6 million will be funded from the short-term debts at 10% interest and the 4 million will be sourced from the long-term debts at 15%. So let's compute the return of equity under the two financing plans. So let's solve this one. So let's have first the plan A. So that is conservative. So according to the problem, so 5 million is the earnings before the interest and tax. Then interest on borrowing, so we have 2. So we have the short term amounting to 2 million, while the long term is 8 million. So take note that there's 10% for interest for short term. So that is actually 200,000 pesos. On the other hand, the interest for the long term, okay, borrowings is 15% times 8 million. So this is 1,200,000. So if we will add our interest on borrowings, so the total is 1,400,000. Now, to get our earnings before tax, we subtract the earnings before interest and tax by the interest on borrowings. So we have 3,600,000. Then, we will subtract the tax. The tax applicable is 30%. So 30% of 3,600,000 is 1,080,000. So subtract. So to get your income. Net income of 2,520,000. Now, if we want to find out the return on equity, we divide the net income applicable to ordinary shares divided by the total number of shares, which is 10 million. So that is why the return on equity is 25.20%. On the other hand, if we will solve the financing plan under conservative, so take note that 5 million is our earnings before interest and tax. And we have the following borrowings. So we have for the short term, we have 6 million and 4 million for the long term. take note that we have 10% rate of interest under the short term. So the interest is 600,000 pesos. And we have 15% of 4 million under the long term financing. So we have 600 million. So all in all, we have the interest of 1,200,000. Now, to get our earnings before tax, we subtract the earnings before interest and tax by the interest on borrowings. So you have 3,800,000. Now, we will deduct also our tax applicable is 30%. So if you will get the 30% of 3,600,000, so the amount is 1,140,000 pesos. Again, if we will get the net income, subtract the earnings before tax and tax, so we have 2,660,000. So this is your net income. Now, to find out the return on equity, so we divide the net income on ordinary shares divided by the number of shareholders, which is 10 million. So you will come up with 26.60%. Under the normal situation, the return on equity under the aggressive approach is higher compared to that under the conservative approach. So that ends our lesson. So again, this is teacher Onedi Guzman. Do not forget to subscribe to my channel so that you will be notified about my new videos. Thank you.